If you've been sitting on the fence waiting to purchase a home, I'm going to tell you about how much time you have until that home doubles in price. But that's not the only thing that's going to be going up in price. Thanks to inflation, everything else in the economy is also going to be increasing along with those home values. So we're going to talk a little bit about that, as well as dive into a little bit that you should be considering when it comes to assets that are generating you income, or at least increasing in their value along with inflation as well. So to start things off, we'll talk about that doubling of the housing prices. So there's this thing called the rule of 72. And if you've never heard it, it states that whatever you think your rate of return is going to be, you take 72 and divide it by that number, and that will give you about the number of years that you can expect for whatever it is you're calculating to double in value. So for example, let's say that you have a house that is appreciating at 4% year over year. Well, you take 72 divided by 4, and that gives you 18. So on average, at a 4% appreciation year over year, in 18 years, that home will have doubled in price. So this is key. And I didn't just pick 4% out of thin air. The average appreciation of homes over the last 60 plus years has been a little bit higher than 4%. So at a 4% appreciation year over year, homes are doubling about every 18 years. So that home that you could purchase today for $300,000, if homes continue to appreciate on average at 4% year over year, that means that 18 years from now, that home is going to be worth $600,000. But check this out. If that $300,000 home were to appreciate at, let's say, 4.3%, so just a third of a percentage point higher, now that home is going to double in 16 years. So that's a whole 2 years less that it takes for that home to double by just adding a third of a percent increase in the appreciation rate. So you can see how quickly these homes can start to really get up there in price, depending upon what's happening in the economy with inflation, but also just with the value of homes in general. We saw a huge jump up with the pandemic, and honestly, home prices are expected to continue to climb as well. If for no other reason than inflation, home prices are going to go up. So inflation is something that's just natural within our economy. It's part of our economy growing and expanding, but with that, it also devalues the dollar. Whatever you have, whatever the rate of inflation is, that is how much more you're going to have to make the next year just to be able to purchase all the same things that you could purchase with the amount of money that you made the previous year. And so that's what I'm getting at when I'm talking about inflation, is the constant increasing the cost of goods and services, but also the devaluing of the dollar a little bit, because it takes more of those dollars to purchase the same goods and services. So inflation is something that affects home prices. If home values, like the value of the home itself, didn't go up because homes were, more in a higher demand, they would still go up because of inflation. So that home that might be worth $400,000 today, at that same, let's say, 2% inflation rate, that's $8,000 more. So the next year, that home is worth 408. However, on average, over the last 60 plus years, homes have appreciated at a little over 4% year over year. And so that's something that's really key that you want to be aware of, because having a house is an asset that is increasing in value over time. And most of the assets that people own, most of the things that people spend their money on, are things that decrease in value over time, are things that are expendable, meaning eventually they're not going to have them anymore, something that they don't even own, such as a streaming service that's just there for your entertainment. But having ownership of something that's actually increasing along with the inflation rate, and homes actually increase at a higher rate or appreciate at a rate that's slightly higher than inflation historically. So owning assets that are actually growing in their value is something that can really help you to grow with the economy, even if not grow your wealth. Because let's say if inflation is happening at a 3% inflation rate, and your house is appreciating at a 3% inflation or at a 3% rate, then as the economy inflates, your house inflates right there along with it. You're not getting any wealthier because your house is staying right there at the same inflation rate as the economy. However, if your home is appreciating at a 4% rate, while the economy's inflation rate is at a 2% or a 3%, well, now you're growing wealth there because your home is actually outpacing inflation. And that's what tends to happen in the economy, is that homes outpace inflation. But why am I starting off with the doubling of the housing prices? Because I really want you to grab a hold of you owning something that's going to one day be worth twice as much as what you could have paid for it if you had gotten it sooner. If you plan on being, living anywhere for the next 18 years, 20 years, it's going to cost you money to live there. Whether you're renting or whether you're owning, you're paying some money there. So again, if we're talking that average of a 4%, historically, again, I don't know what home prices are going to do moving into the future, but looking at the past 60 plus years on average, and that includes the 2008 recession, where everybody likes to point to how the housing prices dropped in 2008, including that drop, home prices still have appreciated on average at 4% year over year for the last 60 plus years. So when you're looking at that and you're looking at 18 years from now, the same houses that you could purchase today for $300,000, $400,000 are going to be worth $600,000, $800,000 into the future. That's something that you should really grab hold of in terms of thinking, do I want to start owning a home? Even if it's not going to be a place that I'm going to live in permanently right now, maybe I at least buy and have ownership in something that I can rent out to someone else, because that same home is still increasing in value over the years. And 18 years from now, maybe you're 20, and 18 years from now, you're going to be 38 years old, and you're going to be paying twice as much for that home as what you would have paid at 20, assuming you start buying homes at 20. But hey, if you do, great on you, because you know what? You're getting that start much earlier than what most people are. I bought my first home when I was, I think around like 26 years old is when I bought my first home. And so again, the earlier you can get that start, the better for you. And so if you're, let's say 30 when you buy that first home, by the time you're 48, that home's going to be twice as much. So the longer that you wait, or the longer that you continue renting, the more that you're losing out in terms of that equity or that value that you would have had in that home had you have purchased it sooner on. So moving on from there, if home prices 18 years would be twice as high as what they are today, how much do you think rent is going to be? Because I know a lot of people that say they can't afford to purchase a home. However, how is it that you can afford to rent? Because home prices, you purchase a home now, you might pay more initially for a mortgage, but your break even, or that point at which your mortgage is now about the same as what rent will be, it might be 5 years, it might be 6 years, it might be 4 years, it might be 7 years, but at some point, you're going to reach that point to where now your mortgage is going to be about the same as what your rent is. And the way that that happens is because when you start out, yes, your rent might be lower than what your mortgage is. However, your mortgage is set for 30 years. That principal and interest doesn't change. However, your rent is constantly increasing year by year at an average rate between 2 and 5%. Depending upon where you live, it might be 2% in some places, 5% in others. But on average, it's between 2 to 5% that is increasing. So you've got that mortgage that's staying pretty consistent. You might have taxes and insurance that increase a little bit, but that mortgage payment that you're making is staying pretty consistent, whereas every year that rent is increasing a little bit more, a little bit more, a little bit more, until you get to that point to where now mortgage and rent are about the same. So that home that you purchased 6 years prior or 5 years prior, however long, now the mortgage payment for that is equivalent to what you're paying today in rent. But guess what? It doesn't stop there, because the next year now you're surpassing it and you're paying more for rent than what you would have paid for the home had you purchased that home 5 years previously or 6 years previous, whenever that break even point is or that match up point is to where now your rent and mortgage are the same. If you had purchased that home previously, now you would actually have a lower mortgage payment than what you're going to be paying in rent. And that's going to continue. That gap between the rent and the mortgage is going to continue to get wider and wider in favor of the mortgage, which would be lower because you had purchased that home later on. So it's always interesting when I'll speak with someone and they're like, I can't afford to purchase. Rent is cheaper than a mortgage right now. It's like, rent is cheaper than a mortgage right now, but rent would not be cheaper than a mortgage had you purchased a home 5 years ago. And 5 years from now, you're going to say the same thing. Rent is cheaper than a mortgage, but it's not going to be cheaper than a mortgage, or it would not have been cheaper than a mortgage had you have purchased a home 6 years ago, 7 years ago. Your mortgage would actually be cheaper right now than you renting. And not only that, you'd have a lot more equity because over the last 6, 7 years, that home may have increased $50,000, $80,000 in price, plus the amount that you would have paid down on the principal balance of the loan through making your on-time monthly mortgage payments. So again, you look at it from the standpoint of rent is cheaper than a mortgage, and you're always looking at it from a present tense standpoint. Well, then yes, rent's cheaper than a mortgage in many instances. However, if you had purchased a home 5 years ago, 6 years ago, your mortgage very well could be cheaper than what you're paying in rent right now. And if you continue with the same mindset, then 5 years from now, 7 years from now, your rent would have been a lot more than what your mortgage was if you purchased a home today. So those are some things that I really want you to grab hold of. What do you think rent's going to be 18 years from now, 16 years from now? We don't even know what the appreciation is going to be for houses moving forward into the future, but I can just about bet you homes are going to be more in the future than what they are today. And they're going to probably be a lot more 18 years from now than what you could pay for them today. And again, if for no other reason than inflation, home prices are going to be going up. So wherever you're at right now with maybe not wanting to buy because of the price of buying, think about what it's costing you to rent, because there is a cost associated with renting as well. Beyond just the monthly rent that you're paying, look at the difference between what you would have saved and the equity or the wealth that you would have generated by owning a home, because that's the part that a lot of people leave out. They're just looking at the month to month, forgetting the fact that, well, 8 years from now, 10 years from now, I might have over $100,000 worth of equity in this home. I might have $150,000 worth of equity in this home. And with all of that equity, that's just wealth for me. So if I wanted to do a home equity line of credit or a cash out refinance, I could access some of that money to go and buy another property. Or if I wanted to sell that home, I could take that money or a portion of it and use that to go, scale up and buy the next home that I'm really wanting to purchase. So these are some of the things that I'm really wanting you to hone in on and think on when it comes to, should I purchase a home? Should I just continue to rent right now? Again, it's up to you, and it's your decision to make for what's going to be best for you at whatever point in life you're at. But you really do need to know at least the numbers on when these homes are going to be doubling in price and at what rate historically homes have appreciated. Because again, 60 plus years, I guess most of the people that are listening to this podcast right now are probably less than 60 years old. And so that means that for more than your lifetime, homes have appreciated on average at 4% year over year, which means that these homes are going to be doubling sometime in the next 20 years. And so that's something that you really want to be aware of. But inflation rate, before I get off of this topic, the inflation rate is at around 3% right now, a little over 3%, but let's just say 3% exactly is what inflation is at right now. Homes are typically outpace inflation a little bit. However, if at a 3% inflation rate, in about 24 years, between 23 to 24, so a little bit less than 24, but in about 24 years, the cost of goods and services are going to double. So let's say that if you're 35 right now, 24 years from now, when you're 59 years old, the cost of everything is going to be about twice as much on average as what you'd be paying today for it if it rings true that we maintain a 3% inflation rate. So those are some things that you need to keep in mind as well. The cost of goods, the cost of services are going up, but it's not something to fear and not something to worry about, because also what should be going up is your earning potential, your earning power. Your earning potential should also be realized in the amount of take-home pay that you're receiving year after year after year. So yes, we have the cost of goods and services that are going up, with inflation rates that are at 2%, 3%, whatever. But next year, you should be making more money than what you're making this year. And the year after that, you should be making more money than what you're making next year. And so your earning power, your income should also be increasing along with, or rather, hopefully outpacing inflation, so that you can actually build wealth rather than just maintaining your standard of living. So those are some things that you have going in your favor as well when it comes to what you can do to combat some of the inflation, the increase in housing prices and everything like that. So don't let the increases scare you, but it is something that you do want to be aware of. So when it comes to, we spoke a little bit on having assets that are increasing in value over time. It's something that most people don't have. But when you look at wealthy individuals, most wealthy individuals build their wealth, maintain their wealth, continue to grow their wealth by placing their money in assets that are growing in value over time. A lot of wealthy individuals invest in real estate. A lot of them invest in businesses. Both of these things have the potential to drastically increase the amount of wealth that you have. So a lot of people who are not wealthy tend to put their money in the banks, and even the banks know that that's a losing proposition in terms of just keeping your money in because the banks don't even keep their money in the banks. The banks loan their money out so that they can get it back with interest by giving you a loan for a car at a 8% interest rate or 7, whatever that interest rate is that you have. They loan it out by giving you a credit card and then charging you a 20% interest rate or 21% interest rate when you have a balance that you're carrying over from month to month. They spend a little bit of that money to write a mortgage for someone to go purchase a home, but then they're getting 5, 6, 7% interest rate return to them on that $400,000, $500,000, $600,000 home that they're buying. Even the banks know that it's a losing proposition to just put your money in the bank and leave it there. They want you to put your money in the bank so that they can take your money, loan it out to other people, make a whole lot of money back on it, and then they give you a little bit of interest, like a 0.00002% interest rate that the bank will give you on all the money that you have just sitting there. Meanwhile, they're loaning it out and they're making a ton of money back. That's going to benefit them, because banks even know that having their money moving is going to help it grow rather than it just sitting still somewhere. And so I know someone out there is probably thinking, okay, but you have wealthy people that also get wealthy in the stock market. That's not investing in a business or real estate. Well, technically, when you purchase stocks, you are investing in a business. So you don't own the business, but you do, in a sense, own shares of the business. You don't have like a controlling ownership of the business when you purchase stocks, typically, but you have shares in a business. So as that business does well, as it profits, as it continues to grow and make more and more revenue every month, that's how shareholders are benefited when you see those increases in the stock prices, because the business net worth and the value of the business is increasing as well. So buying shares or stocks is another way that you can also grow your money. It works a little bit differently with stocks than it does if you were to own a business, because obviously It's more of the long game that I like to look at it when you're investing in the stock market. I'm not more of the buy and sell type of trader. I'm more of the buy and hold for the long term because I believe that's where you're going to really see the benefits is just by buying stock in great companies with great management teams that really have a vision for a business that is filling a need that is in the world currently. And I believe that those businesses have a lot of potential to grow in the long run. And so I'm more of the buy and hold, but you do have some traders out there that are able to make money by buying and selling, and some people that do options and do okay with buying and trading options as well. But again, it's all part of a business. And part of the things that wealthy people are doing is that they are taking their money and they are placing it in something that's going to grow their money. So they're having their money work for them. They own a business or they're investing in a business. And as that business is working, the money they have invested in that money is growing and making more money. You go and you purchase real estate and then you rent that real estate out. So that real estate is appreciating in value, but also the renters are paying you money as well. And that money is being used to service any debt that you might have on the property, as well as if you're cash flowing, then it's putting money into your pocket to save for a rainy day or for whatever it is that you want to use it for as well. So those are some things that you should also think about when it comes to assets and what you are going to do with the funds that you have. Because again, a lot of people don't have assets that are increasing in value over time. Most people don't own businesses. You have a lot of entrepreneurs who have businesses, but those businesses aren't at a level yet where it's able to afford them the type of lifestyle that they want to have. A lot of people spend, especially if you're first starting out as an entrepreneur, you're spending all of your time working in that business to try and get that business to be a multi-million dollar business. If that's your goal, you want it to be really successful. But the thing is, at some point, you have to have your money work for you, i.e., hire other people to do the work that's going to save you time so you can focus on other things, or maybe even be able to take a step back and enjoy some of the wealth that you've been able to generate through that successful business. Now, a lot of entrepreneurs and small businesses don't ever see it to that level. But again, backtracking to where we are, getting back to where we were initially talking about, having those businesses, owning those businesses, investing in those businesses, even if it's not a business that you are running, you can still invest in good businesses through owning stock. You can invest in good businesses through a number of ways. You can invest in real estate investment trust, or REITs, as they're also known as. That's a way that you can invest in real estate without having to buy an actual home. It's another way that you can invest in real estate and get paid dividends from that investment as well. So that's one way that you can, for a lot less of your income, have a much bigger return 10, 15, 20 years down the road if you're a buy and hold type of investor. So these are some of the things I just wanted to talk about in this episode. First and foremost, just talking about, what the value of everything is going up. Home prices are going to double at some point. What that point is will be determined as we continue to see what the appreciation is from year to year on average. But I'm guessing it's probably going to be around the 4% range. That's what it has been for the last 60 plus years. It could change. Maybe it ends up going to 5%, which means that home is going to double a lot sooner. Maybe it goes down to 3% and it takes closer to 20, or maybe a little bit over 20 years for that home to double. But in any case, that home's going to double at some point. And if knowing that your dollar today could be worth $2 at a future date, why would you not want to put your investment in that asset, knowing that, hey, I could invest 300,000 today, and you don't even have to have 300,000, because when you purchase a home under an FHA loan, you only have to have 3.5% for the down payment, and there's down payment assistance that can help you take care of that 3.5%. So you really only have to pay the closing costs. However, knowing that you could acquire an asset today and that asset is going to be worth more or double in value at a future date, maybe 16 years in the future, maybe 18 years in the future, to be determined. But knowing that that asset is going to double, in my mind, it just makes sense to put your money in a place where your money is going to grow. You want your money to be making more money for you, and you want to be making decisions that are actually going to put you in a better place financially. A lot of people tend to focus on the here and now and the entertainment, which is nice to have the entertainment, but what's not nice is 15 years from now, you're still renting a home, paying much more with your rent money than what you would have been paying had you bought a home 15 years prior. And you would have not only been paying less, guess what? With that gap between what you are paying in rent all the way up here versus what you would be paying in a mortgage down here, what could you have done with all of that money? That money, you could have taken it and used that for your entertainment, or you could have taken that and reinvested all of those savings so that your money makes you even more money. And that's how people grow wealthy. That's how people build fortunes, is by being wise with how they're utilizing their money and what they're doing and what they're investing their money in. So these are some of the things I just wanted to drop on you. Hopefully you found it to be of benefit to you. Look forward to seeing you in the next episode. Please do like and subscribe to the podcast. Do all of that good stuff that you do on YouTube to let me know that this is something that is blessing you, something that is really helping to move and propel you forward in the right direction as well. So look forward to seeing you in the next episode. Take care. Be blessed.